Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Getting Started with Options. And today, I wanted to go through three Thinkorswim tools that pretty much every options trader should know. I think this is going to be an interesting discussion of building a trader's toolbox. A lot to cover. Before we get to that, though, let me first of all say hello to everybody who's already chatting in out there in YouTube. I always like to look out there and see the familiar names. So hello there, Kevin and Ricebird and Lawrence. JDLMI, Robert, Eva, Paul, Janelle, everybody else, thanks for joining us week after week. We always appreciate your attendance and your contributions to these discussions. If you're here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the live stream is concluded, enjoy the recordings. It's really a great way to watch these webcasts, but be aware that you're invited to join us in the live stream. And if you'd like to be here, this is a Tuesday webcast series. We kick things off promptly at noon Eastern time. Now, I also want to let my live stream audience members know that my very good friend Mike Fairborn is going to be hanging out in the chats with us. He's going to be keeping an eye on the questions that come in through YouTube chat. And if I can't get to those, Mike's there to pick up my slack. Mike, thanks for having my back there. Definitely appreciate it. Mike and I would also like to issue an invitation to everyone watching. You should be following your favorite Schwab presenters on social media. You can find Mike and me on X. You can find Mike there at Mike Fairborn CS. My handle on X is at Cameron May CS. Now you can also follow me now on LinkedIn. Just go to linkedin.com/in and then /Cameron May CS. I'll take you right to my profile. But social media is really the best place to connect with your favorite presenters in between the live streams when the camera's not on. All right, but let's get into this discussion. Let's, first of all, of course, consider the risks associated with trading and investing. These are important disclosures, so bear them in mind. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as a sole means of investment research, and investing involves risks, including the loss of principal. Okay, so let's set an agenda for today's discussion. I actually see a question. Let me quickly address this question because I see Ray saying, "You're a new investor. Great to have you here, Ray." Then mentions a few stocks they have. You'd like to learn how to sell covered calls or puts for some extra income. Interestingly, I have a regular YouTube webcast series right here on the channel. It's called Trading Covered Calls and Short Puts. So you may want to check out that webcast series for that discussion. Today, we sometimes talk about those strategies, just not today. So wanted to give you a resource, but in any case, what are we talking about today then? Well, I want to talk about three what may be considered by many to be key tools on the Thinkorswim platform that pretty much every options trader should know that can give some important context for current options prices, for expected options prices, and for options prices within the context of an entire portfolio. So I think this is going to be an important discussion. So the first thing that we're going to do is set up just an example trade scenario on a long call. We're going to keep the strategy as straightforward as possible so we can focus on the tools. But we're going to talk through these three tools, and then we're actually going to wrap up the discussion by placing an example trade, having supplemented that effort with these tools. All right, so let's go right to the Thinkorswim desktop. So we're on Thinkorswim desktop trading software platform. This is the paper money version of Thinkorswim desktop. And I just wanted to create what I think is kind of a straightforward hypothetical scenario for a would-be long call buyer. That's a bullish option strategy. Let's say that our trader here has been looking at Meta, and they notice that Meta has recently run up against a previous trend, pulled back, and it looks like it's establishing higher lows now, finding a potential support around 640. We're starting to get some bullish momentum in today's trading. And let's just say that it is this trader's outlook that they think that Meta is likely to continue this upward trajectory and just go up to previous highs. You'll notice we've had highs right around 680 before on a couple of occasions following a strong gap down. And it's a common technical assumption that when we have a gap down, the bottom side of that gap is likely to act as a new support or resistance in the case of, just reverse that. It's likely to act as a new resistance or a price ceiling. And let's say that's the trader's assumption. One note I do want to make about this chart is that we have this really funny looking candle right here. Did anybody notice what happened with Meta a few days ago on the candles? What happens every once in a while is there will be a misquote that comes across the wire, and it prints one data point for the candle way out of place. So no, Meta Platforms never traded near $711 on the day on Friday. So actually this candle is just a kind of a normal small red candle down at the bottom. Ignore this tall wick, it's just a misquote. Anyway, so there we go. There's the premise of our trade. Let's say that our trader thinks that we're likely to go up maybe within the next week, maybe stretching it to 2 weeks, but that's the outlook, up to that $680, we'll call that the near-term price target. So they have the idea, let's leverage this, we're going to go buy a call. Now, before I do that, what some traders might employ first to get some context about the pricing of calls and puts on Meta is a tool that's found right here on the charts. So tool number one is going to be found right up here under Edit Studies, and I'm going to type in IMP and then start to type in volatility. We're going to talk about the implied volatility tool. All right. Sometimes I'm reading and I'm talking at the same time, but I see a user out there says, is there a way for us to find that out if the candle is incorrect? Yes, there is. Actually, let me do this. Let's add the implied volatility to our chart and just click apply, and you'll see it down here. But I do want to address that question because it's pertinent. How did Cameron know that this was a misquote? Well, if this trading really happened, then we should see that on the intraday activity if I go to a shorter term time frame. So if I come up here, you'll notice that happened within the last 5 days. So I'm going to switch up here to a 5-day chart. And there should be, especially right here on Friday, some trading up around $711. Do you see any trading up here on $711? Neither do I. Nope. That's how I was able to quickly check. That's a misquote, just ignoring it. So thank you for the good question. There we go. But let's look at this implied volatility tool. And let's talk about the potentially important implications that it might have for a trader. Now, this is before we've even gone and looked at the options on Meta. What is something, some of you who use this implied volatility chart tool, chat in, let me know, what is something that we could state pretty confidently about the pricing of calls and puts on Meta right now? So while you're chatting in those answers, let's talk about what this implied volatility chart might tell us. So if we want to get technical about it, really what this is doing is it's showing us the relative demand for options. Demand for options fluctuates just like it does for just about any tradable asset or investable commodity. And what we see is that as that demand fluctuates, prices tend to fluctuate. So this is really just a chart based on the general pricing of options. It's an indication of changing demand and supply, right? So when we see a peak here, a typical interpretation might be that demand is at a peak and therefore prices are likely to peak. That's important. So if we look at where we are right now with implied volatility, we have low implied volatility, which might reflect comparatively low demand, which might also imply low prices. Yes, for some traders, what they'll look to the implied volatility tool for is a gauge for what are prices on options on this stock. This is specific to Meta. Are prices of options generally high or generally low right now? Because if I'm going to go buy one, maybe it's important for me to know whether I'm paying comparatively low or high prices. So a lot of you chatted in. Let me see what the comments were. Okay. David says low prices on options. K&G says less expensive due to low volatility. Noodlebrain says they are expensive. Well, they can be, right? Even if they're relatively inexpensive compared to where they've been in the past, doesn't mean that they're going to be, that we're going to get a great deal now. and that they're certainly going to go up in price, right? But near lows, Dom says, Mary Burns says cheap options. Tony says premiums would be lower. That's it. Yeah, now this is not a guarantee that every single contract, that every single strike price is at or near lows. But yes, when the trader looks at the implied volatility tool, and you note where this is right now, and we look over the last 12 months, there have been only rare occasions, one or two short moments when implied volatility was lower, and therefore options prices across most of those strikes on Meta platform for calls and for puts were low. So for some traders, they might call this a buyer's market for Meta contracts. Now, does that guarantee that prices are going to go up? No, it doesn't. Does it even tell the trader whether it's a buyer's market for calls or for puts? Actually, both may be experiencing comparatively suppressed prices. But what we can know, what we can state with a fairly high degree of certainty is, well, at least we're not paying very high prices compared to where we've been on average or typically over the last 12 months. Now, there's another thing that can be observed right here using this tool, and that is why prices go up and down like they do. A common driver of demand is actually earnings. Let me pop up here. I'm going to click on the little gear icon. Let's go to equities and let's show corporate actions, including earnings. So if I click apply now, this will give us these icons that show us the earnings announcements for Meta. And this is fairly typical, but generally speaking, starting several weeks before an earnings announcement, moving toward the earnings, demand will tend to drift or move higher. Kind of started here. Let's just move up toward there. Here, move up toward there. But I think you can see a general emerging pattern there. And that is because as earnings approach, volatility increases. And when volatility tends to increase, there tends to be greater demand from speculators in options and also from hedgers using options to hedge like stocks in their portfolio. So there we go. Bottom line, the implied volatility tool might give the trader a general gauge into whether they are, in the case of buying, well, just in the case of trading, are we trading at relatively high or low prices? Okay, so that's some context for the current pricing of options, but we need another tool that might give us a gauge for where we expect prices to go. What about future prices of options? All right, let's say that our trader thinks we're somewhere in between. You'll notice we've had earnings about, that looks like that was about 9, maybe 10 weeks ago. So maybe we'll start to get this increase in volatility, increase in demand for options, maybe dragging prices up generally. And let's say that we expect the stock price to go from maybe around 650 up to around 680. That's up around 29-ish, maybe $30. And finally, so we've talked about price, we've talked about volatility. There's one more element in the pricing of options, that is the passage of time. Let's say that we maybe expect this move to happen within the next 7 to 10 days. Well, if we get a move upward of $29 or $30 over the course of 7 to 10 days, while demand for options generally is rising, what might that do to the value of a call that we purchase right now? We need a calculator for that. Guess what? We have a calculator. Let's go to the Trade tab and look at tool number 2. So I'm going to use the MetaTrade. Let's say we're looking out to, let's buy some contracts that will give us at least those 7 to 10 days. I'm going to stick with the monthly contracts. We could go for a weekly. Let's say we give it a few, a couple extra weeks. We're going to go out to the 16th of January. These monthly contracts tend to have a little bit better pricing, a little narrower spread between the bid price and the ask price. So with the stock trading around 650, let's say that our trader has determined they're going to buy the $650 call. Now, that's not exactly how strikes are always selected. I'm just going to say for this example, let's say that we're thinking of buying that 650 call. Instead of buying the stock for 650, we're going to buy the right to buy the stock for 650. How much does that cost right now? between 22 and a half and maybe, well, it looks like it was around 22.30 to 22.50. Obviously prices are changing, but around $22.50. So that's the current price of this call. And because we checked the implied volatility, we can be reasonably confident that this is just about as low as a call of this nature has been over the last 12 months. That's kind of nice. But my question now is, well, if we pay $22.50 for this call and the stock goes up to our target price of 280 within the next 7 to 10 days, while volatility is rising, what's the net outcome for the trade? We're trying to get a peek into the future, and this is where this next tool might come in handy, and it's known as the theoretical price tool. What we've done is we've just proposed some theoretical scenarios. We don't know the future, so we have a theory about what might play out over the next 7 to 10 days. Let's run a calculation to see the impact of our on our call. So I'm going to come up here and change our columns. So bear with me for just one moment. I want to show you this. So right now we're looking at the last price of our contracts and the net change in those contracts. Those are our customizable column headings. I'm going to switch those column headings to something known as the Theo price and the market price. Okay, so as I change to Theo price, you'll notice two changes here. First of all, we have a column that says Theo price, and we have this over here. I'll explain this in just a moment. But the column that says Theo price is preparing now to show us a future theoretical price. Now, we haven't made any changes to our assumptions. So right now, if we look at that 650 call, it's pricing somewhere between 22.60 and 22.80. Well, that's 22.70. This is not a theoretical price. It's the actual price of the contracts right now. So let's generate a theoretical price by clicking on this tool now. And this actually brings up a calculator that allows us to put in variables that affect the outcome of an options trade, including time, price, and volatility. So how long did we think it was going to take to maybe get up there to 680? Could be 7 to 10 days. Well, let's say it's 10 days. Let's click on our little calendar here. Today's the 16th. The 23rd would be a week from now. How about we go out to, look, there's Christmas. You can see it in red, kind of calling attention to it's a different day. You know what, let's go right to the day after Christmas. All right, there we go. Giving it 10 days to maybe move up to 680. Just by adding that time element, we've already added an assumption. It's a theoretical assumption to the value of our contract. And this contract that we right now maybe could buy for 22.5, if we bought it and nothing happened except 10 days went by, we would have some time decay. So the theoretical price calculator is telling us that time decay element has already subtracted about $4 of value from this contract. Well, we don't want this to just sit there and go nowhere for the next 10 days. Let's say that we expect the stock price to go from, oh, look, it's already moving. It was 651, it's now 652. That leaves us about $28. I'm going to do a little bit of rounding here. Let's just say $28. So we'll type in 28 here. So now we're telling the system, let's assume that over the next 10 days, by December 26th, our stock price has gone up $28. Well, the time decay is still built into that assumption, but we now have the appreciation element in the stock price. What's the value of that contract now? About 37.5. So if we bought it for 22.5 and it's now worth 37.5, that's about a $15 increase in the value of our investment. That's what, 65%? Right about there. So it's a pretty nifty tool. Now there's one other variable that could play a role, and that is volatility. As volatility fluctuates, so does the pricing of options. And we saw that our volatility was relatively low. Maybe it'll start to rise over the next 10 days. It's not a lot of time for volatility to move. Let's see if we can get an impact. Let's just increase our volatility assumption by just 1/10 of 1%. This is going to be subtle. Right now we're at 37.5. Let's hit enter. And it's really, yeah, didn't have a huge impact. Probably just got absorbed by the general movement of the options right there. But rising volatility will tend to at least help to offset some of that time decay. It can increase the value of the contract. But this tool is a tool that a trader might use when they've gotten some context about current pricing of options, but they want to know what's the potential for this contract if the stock does what I think it might do within the time frame that I expect it might do it. All right, so two potentially powerful tools here. Now, the final one that I want to show you, we're going to get a little bit deep in the weeds in this. Let's see. Hope Thomas says the Theo price parameter is a must-have in your options toolkit. Thanks for sharing this, Cameron. Yeah, I think you can see the potential value of the tool. Now, just because we put in some rather attractive looking parameters in this tool, does that mean that we're guaranteed a $15 return? No, because the stock might not do what we expected. However, having said that, I will say that this tool is extremely accurate. It will absolutely nail the price as long as we nail our assumptions. If the stock goes up exactly the prescribed distance in exactly the prescribed time and volatility behaves in exactly the way that we anticipated, the outcome will be that will be the future value of the contract, because this calculator uses the actual algorithm that is used to price options. It's not an estimate. It is an exact calculation, but obviously depends on the precision of the assumptions that we put into it. Okay. Eric says, can you compute the volatility increase needed to offset theta for the time horizon of the trade? Yes, we could, Eric. It'd have to be a lot. I'll tell you that. And then we're probably not going to get it, because if we go back to this chart, if we'll notice, here's our implied volatility going up and down. How much is it actually going up and down? It's going from 0.27 up to 0.52. It's not huge jumps. So we're probably not going to see massive increases. Okay. In any case, let's see. Hope says I used it for 2 calls recently and it was spot on. Well, that means that your assumptions were spot on. So congrats to you, because if the assumptions are off, the calculator can't make up for those sorts of shortcomings. But we've learned a tool that might give us some context about current pricing. We've learned a tool that might give us some context regarding future theoretical prices. Now let's get into this final tool, which helps us just sort of visualize it all. And so we're going to go now to our Analyze tab, and we're going to put this trade that we're considering into a simulated environment. On the Analyze tab, let's go to Add Simulated Trades first. Let's go to the 16th of January. It looks like the same options chain. It works just like the options chain, but this is a different tool than the Trade tab, which is where we just were. So we're on the Analyze tab, Add Simulated Trades. Let's go down to the 16th of January. And I'm going to click on the ask price. It looks like the price of our contracts have gone up a little bit. That's nice for the premise of this discussion, going in the right direction, but not guaranteed to keep going that way. Let's click on the ask price, and this is going to create a buy order for 10 contracts. I want to just dial this down to just 1. I think it's easier for us to just talk about 1. All right. But by creating this order within the Add Simulated Trades tool, I can now just go right to what's called the Risk Profile tool. And this is going to bring up a chart of the potential for profit or loss on this call. And yes, it includes the assumptions that we already put into our Theo price calculator, but it can go way beyond that. It also shows it visually, which for some is highly appealing. All right. So let's talk about what this tool is. So down here is our trade. Right up here is sort of a chart or a grid of potential profits or losses. And they're based on the same assumptions, price, time, and volatility. But you'll notice there's a reference point. Is the stock really, look at this, stock's right at this 652. That's the current price of the stock. It's actually at 652.02. You'll see that move as the stock price is moving. But that's what this is referring to. Then over here, so we basically have a a stock price axis on this chart or grid. We also have a profit or loss axis. So this is telling us if the stock goes up or down, what's likely to happen to profits or losses on this call option. So you'll notice with a reference point at 0, so this is break even. That's what the red dash is. We can only lose so much on this call option. So let's lock it in. Let's say we bought it for $22.50. How much is the most theoretically that we can lose, setting commissions aside? Just flat out on the contract. Well, theoretically, we should only be able to lose $2,250. $22.50 per share on 100 shares is $2,250. Well, you'll notice this yellow line actually bottoms out at $22.50. And under what circumstances might we lose that money? Well, the yellow line assumes that we just put on this call, we let it go all the way to expiration. That would be out on the 16th of January. As of the 16th of January, if our call contract is below $650, well, if the stock is below $650, we then have the right to buy shares for $650 that aren't even worth $650. We'd be overpaying to exercise this contract. So that creates our maximum loss scenario as represented by this yellow or gold line. If we're above $650 at expiration, we're doing better. Now notice, better doesn't mean profitable. Not under every circumstance. What if our stock is at $660? We have the right to buy the shares for $650. Awesome, that's a $10 value that we paid $22.50 for. We'd have a loss. How much of a loss? $1,250. So at expiration, we climb up to this dashed line, or this red line. That's the break-even point. What's the break-even for this trade? If we buy the contracts and we let them go or the contract, if we let that go all the way to expiration, break-even is actually at $672.50. Because if the stock's at $672.50, we have the right to buy the shares for $650. Awesome. We get to buy those shares for $22.50 less than they're worth. That's great, except that we paid $22.50 for that right. That's a wash. That's break even. So I think you can see how this is outlining the potential for loss and the potential for gain. So if we allow this to go all the way to expiration, where do we need the stock price to go in order for the trader to have even a penny of profit? It needs to be above 672.5, compensating us for the cost of the trade. And then beyond that, with a long call, the higher the stock goes, by expiration, the more that trade can make. There's no cap on how much can be made. And so therefore you see this profit line just extending upward to the right forever. There's no theoretical cap on the potential for gain. That's what that gold line is. Now, but we didn't have the intention of buying this and holding till expiration. So what does that have to do with our trade? Well, maybe our trader just uses this for a quick reference for trades that are intended to go to expiration. If not, we might want to use the other line. So the other line is assuming a date other than expiration. It just starts with today. It doesn't know which date we're looking to trade in or out. So it just starts with today, and it draws a break-even point for today. It shows us how our trade is likely to go if the stock starts going up, and notice it becomes profitable quite quickly. It shows us how our trade is likely to perform if the stock starts going down today, and notice it can start losing money quite quickly. But we can also manipulate this line. Now I'm gonna zoom in on this line. I don't know if you knew you could do this, but over here, so this just draws these lines on here by default. You can actually click up here, and I don't know if you can see this. Anyway, what's happened is I have multiple monitors, and what I'm trying to show you has popped up on a different monitor, but it basically just says, it gives you the choice to choose between a floating scale and a fixed scale. So let me just change that. Let me click on that. I'm going to change that to fixed. And what that allows me to do is click on this right margin and sort of widen this out. What this is doing for you is it allows you to see just a clearer distinction between those two lines. You can actually even click on the chart and drag it back and forth. But for resizing the chart, that's a nifty little tool that's available right up there. In any case, let's look at this blue line. So the blue line is our potential for profit or loss if the stock starts moving today. Well, we were expecting it to move over the next 10 days. So let's go down here in the lower right-hand corner, and you'll notice it has today as the default assumption for this line. I'm going to click on the little calendar down there, and let's push that out to December 26th. And that has now redrawn that line. Keep your eye on that line. You can see the difference as I make these changes. So there's today. Let me click on this again, move it out to the 26th. You can see the line has moved itself a little bit closer to the expiration line. It looks a little bit more like that expiration line. That's because we're closer to expiration. But with that one change, I can now explore potential profit or loss scenarios just by moving my cursor along the price axis or that lower axis. So let's make some assumptions. Let's say, well, first of all, I can see here's where price is right now. Where do we need to be on December 26th in order to have break even? The stock needs to have moved up about $8. Now, not $8, it's more like $6 because right now we're at about $6.52. So moving up to about $6.58, up about $6 to compensate for the passage of time and days. Beyond that, we're in profit territory. So if we're below that, loss territory. And we can actually see specific numbers just by pointing at a specific date. And if we look down here in the lower left, we can see the potential for profit or loss. Look at the blue number because we're looking at the blue line. There's our break even. As we move above that, our profit increases. If we're below that, we're in loss territory. So this is really just kind of scratching the surface with this tool. It's a fantastic tool. We can manipulate our volatility adjustments right down here. I'm not going to do that today, but I wanted to give an introduction to these three tools. So implied volatility on the chart, the theoretical price in the options chain, and then the risk profile tool under the Analyze tab. Three key tools that pretty much every options trader should know. Really gives us a greater understanding of how our options are currently priced and how those prices might change. All right. Now, as I said, this is just sort of scratching the surface of this tool. There are so many things we didn't talk about. So if you'd like to see a more in-depth discussion of this, let me give you a resource for that. First of all, if you haven't subscribed to our Trader Talks channel on YouTube yet, I'd suggest you do that right now. You can go down and click on the subscribe button. You just go down below the video and click on the subscribe button. It only takes a second. It doesn't cost anything. But our Trader Talks channel on YouTube is where you can join our live presentations, or you can find the playlist for previous webcasts, including one that I did that was dedicated entirely to understanding the Analyze tab, that risk profile tool that we were just talking about. So I'm going to click on, well, I could go through the playlist. Let me do a shortcut here. If you just come over here, we can do a search. I'm just going to type in risk profile, hit enter on my keyboard, and you can see Brent's had a discussion about this. But here's one. Let's learn Thinkorswim's powerful risk profile tool. You might want to check that out. All right. Now, Nikki just asked a question, how do you set a stop loss? Let's get to that, Nikki. We've learned these three tools. Let's go place our trade. Now, we could do it from right here. I'm going to do it differently. Let's just do it the normal way. Go to the trade tab, or this is, I don't know if I want to describe something as normal for everybody, but this is maybe the more common way to place our trade. What we'll do here is we've just calculated that if we buy these calls, and if the stock goes up to our target, let me bring up our chart. It'll help me visualize this one more time. Stock's right around 652. We've calculated that if the stock goes up to our target, we might be looking at our $22 call being then worth about 37 or 38. That'd be what, let's say around a $15 profit. Let's make that our target. Well, at the same time, this trade might not work out. There's certainly a possibility the stock could start to waffle around and not go anywhere. Maybe it starts to go down, both of which could be damaging to our call. So let's say that our trader has decided, to go to Nikki's question, that they're going to risk, let's say, a third of their investment. If we're buying in for around $22, a third of that is going to be around $7. So let's say we're going to put in our order to buy the calls. Then we're going to have two sell orders, one to take profits if we make a $15 gain, a second to take losses if we incur a $7 loss. Okay, so let's go to our trade tab. Let's go to that 550 contract. Oh, I need to scroll down a little bit. No, scroll up. What am I looking at? 650. That's why I'm off. 650. Looks like it has increased a little bit in price. That's okay. But I'm going to right click on this and I'm going to put in a custom buy order with an OCO bracket. So what that does is it creates an order to buy some contracts and then two sell orders, one to take potential profits, the other to take potential losses. So for this example, let's just keep it clean and simple. Let's just let's link these buy and sell orders together and let's just change this to just one contract. Okay, you'll notice putting in one order to buy. Now we have an order each to take profits or losses on just one contract. Looks like we're still trading around 22.75. Let's say 22.75 is going to be our limit price. That's the most we're willing to spend. And then we were thinking, well, if we get a $15 gain, in other words, if we're getting up around that 680 level, maybe we'll take our profits. A $15 profit here would be if we can sell for 38 or 37.75. Yep. Let's put that in. We'll make that a good till canceled limit order. So this would be, hey, I want to buy for 22.75 and then I want to sell for 37.75 if I can. That's the limit though. I don't want to sell for less than that. Now, if the call starts to lose value, we're in at 22.75. Let's say that we will put in a stop $7 below that. That would be at 15.75. I'll make that good till canceled. So in this case, we're risking about a third. $7 of 22.75. I realize isn't exactly a third, but close. The concept here being, let's say that our trader is willing to risk, about a third, maybe 30%. Whatever the percentage is, that's up to the trader, but this is how we could put in that stop. All right, there we go. That's our full round trip trade, putting in an order to buy. We have an order in to take profits if we can get up there to 37.75. We have an order in to stop the bleeding. What this does, if the value of the contract drops down to or below 15.75, it kicks off a market order and we sell for whatever we can get at that point. So it might be 15.75, it could be less. Okay, but let's click confirm and send. Going to buy one contract of the 16th of January 650 calls for not more than 22.75. And if we can do that, then we'll have a plan to sell at 37.75. That's up $15, or sell at 15.75. That's down $7. There is a commission on both sides of a trade to get in and get out. Let's send that order off. Now, how much is this going to cost us? About $22.75. That's the maximum that we're putting in, plus commissions. So we'll send that order off. We'll see, let me go to the monitor tab and see how that's working. So 22.75 is what we've said we're willing to spend. The market price right now is 22.32. I expect, yeah, that filled pretty quickly. That's what I expected. So we're in that trade. So guys, we've done it. We've learned those three tools. When I kicked things off, I just wanted to set up a quick basic trade scenario that explore that using three key tools on a Thinkorswim platform. So we've learned the implied volatility tool. the theoretical price tool, and also the risk profile tool. I think that these potentially powerful tools might be new to a lot of you. Not going to be new to everybody, but hopefully even those who use it regularly got a little bit of a new insight into those tools. But this is what we do with our Tuesdays. We talk about getting started with options and with the tools that support those efforts. Done, you like that? That was really helpful. Excellent. All right. Well, I'll hope to see you again next Tuesday. Now, I have other webcasts each day of the trading week between now and then, so you're certainly invited to join me there. I'll give you one quick reminder. Please do subscribe to our Trader Talks channel. Do yourself a favor if you haven't done that already. Go click on that subscribe button. This is where you can join the live streams. You can search through the playlist for previous webcasts. You can even do keyword searches through our archives, just like I did during this demonstration. Another thing that Mike and I would suggest you do is to follow us on social media. You can find Mike on X. You can find me and Mike on X. Find Mike there at Mike Fairborn CS. You can find me on X at Cameron May CS. So here's that handle. Make sure that you're precise. There are lots of similar handles on social media, so ours are always first name, last name, CS. Now, the other thing that you can now do is to follow me on LinkedIn. So let me pop over here to LinkedIn. You can go to linkedin.com/in/Cameron May CS. That'll take you to my profile. Give me a follow there. I've only been on LinkedIn for 5 or 6 weeks, something like that. But I do post on here regularly. Now, whether you're replying to one of my posts on X or you're replying to one of my posts on LinkedIn, I just try to reply right back to you. It allows for interaction that's not otherwise available when the cameras are off. One of the nice things about LinkedIn for me is that I can do a more in-depth post. I can get deeper in the weeds on some things, so that's kind of fun. In any case, guys, time for me to let you go. Mike, thanks for helping out in chats. I did not see a survey for this webcast, but anytime you do see a survey, please take the time to fill that out. That's always appreciated. I do also appreciate everybody that's clicked the thumbs up button. If you enjoy a webcast, click that like button. It's a nice pat on the back for your presenter for a job well done, but it also gives our webcast a boost in the YouTube algorithm, helps more people find these things. So thanks, guys. Definitely appreciate it. I will let you go. I'm going to look for you in future webcasts. I'm also going to look for you on social media, on X and on LinkedIn. But whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.